Hello everyone. Today, we're diving into the psychology of money, a fascinating exploration of timeless lessons on wealth, greed, and happiness. This presentation, based on Morgan Housel's insightful book, will challenge you to think differently about your finances. We'll examine the crucial difference between being purely rational and simply reasonable when it comes to managing your money. Our journey begins by understanding that financial success often boils down to soft skills rather than hard science. In essence, how you behave is far more critical than what you know. Consider these two contrasting figures: Richard Fuscone, a Harvard-educated Merrill Lynch executive, who went bankrupt in 2008 despite his extensive knowledge. On the other hand, Grace Groner, a humble charity secretary, lived frugally and quietly, yet left an incredible $7 million to charity. This stark comparison beautifully illustrates our point: behavior consistently outperforms intelligence when it comes to long-term financial well-being. Next, let's talk about the intertwined roles of luck and risk. Think back to Lakeside School in 1968. Bill Gates had the incredibly rare luck of gaining access to a computer at a very early age, a 1 in a million chance that directly led to him founding Microsoft. But for every story of great luck, there's often a parallel tale of risk. His friend Kent Evans, equally brilliant, faced a 1 in a million risk that resulted in a tragic mountaineering accident. The lesson here is profound: be humble when you achieve success, recognizing that luck may have played a significant role. And be forgiving when you experience setbacks, because risk, not poor judgment, might have been the primary factor. This brings us to what we call the Ice Age effect, beautifully demonstrated by Warren Buffett's net worth. As you can see, a staggering $81.5 billion of his wealth was accumulated after he turned 65. Ice ages aren't caused by intensely cold winters, but by slightly cooler summers that consistently prevent ice from fully melting. Similarly, in finance, consistency matters far more than intensity. Small, steady efforts, maintained over a very long period, compound into extraordinary results, far outweighing sporadic, intense bursts of activity. There's a critical difference between getting wealthy and staying wealthy. Getting wealthy often requires a degree of optimism, a willingness to take calculated risks, and a drive to swing for the fences. It's about seizing opportunities. However, staying wealthy demands an entirely different mindset. It calls for a healthy dose of paranoia, humility, frugality, and above all, a strong survival mindset. As the saying goes, planning is important, but the most important part of every plan is to plan on the plan not going according to plan. This adaptability is key to preserving wealth once it's acquired. Now, let's consider the concept of tails you win. It might surprise you, but in business, a significant number of ventures fail. About 40% of public companies don't make it. Even within a creative powerhouse like Disney, hundreds of cartoons lost money. Yet, a tiny fraction, just 7% of companies generate all the market's returns. Think of Snow White. For Disney, that one film paid for the entire studio. What this teaches us is powerful: you can be wrong half the time, or even more, and still make a fortune, as long as you have a few big winners that make up for all the losses. Let's revisit the idea that being reasonable often trumps being purely rational. A rational investor strives for 100% optimization, meticulously calculating every move. However, this perfectionist approach can be brittle. If the math gets complicated or doesn't go their way, they might quit. A reasonable investor, on the other hand, prioritizes peace of mind, aiming for a strategy they can stick with, even if it's not perfectly optimized. They seek to sleep at night. The enduring wisdom here is that a technically imperfect strategy you can stick with is better than a perfect one you will quit. Consistency and adherence are far more valuable than theoretical perfection. Beware the seduction of pessimism. Optimism often sounds naive, like a sales pitch, while pessimism can sound intelligent, like someone trying to protect you. Destruction, or pessimism, tends to be fast, loud, and happens in an instant. Growth, or optimism, is slow, quiet, and unfolds over decades. It's easy to be drawn to the drama of pessimism. Yet, true optimism isn't blind positivity. It's the belief that, over time, the odds of a good outcome are in your favor, even when facing temporary setbacks. It's the quiet engine of progress. What is the ultimate dividend of money? It's freedom, specifically control over your time. While income, house size, and job prestige are often seen as predictors of happiness, studies consistently show that having autonomy over your daily schedule is paramount. The highest form of wealth isn't about having a huge house or a fancy title, it's the ability to wake up every morning and say, I can do whatever I want today. That flexibility and control are truly priceless. Next, let's explore the man in the car paradox. Many of us are tempted to buy expensive things, like a luxury car, because we imagine people will think we're cool or successful. We think, I would look cool in that car. But here's the paradox: people aren't usually thinking about you, they're thinking how cool they would look in that car. Spending money to show people how much money you have is, ironically, the fastest way to have less money. True wealth is often unseen and doesn't require external validation. It's crucial to define enough, because for many, the goalpost constantly moves. Consider the case study of Rajat Gupta, a centimillionaire who, despite his vast wealth, yearned to be a billionaire. He risked everything, and ultimately lost everything, for money he simply didn't need. The key insight is profound: there is absolutely no reason to risk what you already have and need, for something you don't have and frankly, don't need. Knowing when you have enough is a powerful financial and psychological tool. Let's distinguish between fees versus fines. Market volatility, those ups and downs, is a fee. It's the price of admission to participate in long-term growth and is absolutely worth paying. It's not a punishment, it's a necessary cost for the value you receive. Fines, however, are different. They are the cost of bad decisions, a punishment for choices like panic selling or chasing fads. These should be avoided at all costs. The trick, then, is convincing yourself that the market fee is worth it, understanding that patience and resilience are part of the investment. We often suffer from the end of history illusion. When we're young, we might dream of driving a tractor, then in our 20s, becoming a high-powered lawyer, and later, simply finding peace and low stress. The truth is, we are poor forecasters of our future selves. Our desires, values, and even personalities will change significantly over time. Therefore, it's wise to avoid extreme or rigid financial plans, because the person you are today is not the person you will be in 10 or 20 years. Build flexibility into your financial life. So, what's our behavioral checklist for financial success? First, find humility, accept the role of both luck and risk in your outcomes. Second, save for no reason, build a buffer that buys you flexibility, not just material things. Third, manage for sleep, prioritize reasonable strategies you can stick with over purely rational but stressful ones. Fourth, extend your time horizon, let the magic of compounding work its wonders over decades. Fifth, accept tails, understand you can be wrong frequently and still win big with a few successes. And finally, define enough, clearly set your financial goalposts so they don't keep moving indefinitely. Ultimately, wealth is what you don't see. Being rich often means your income is spent, conspicuous consumption to show status. Wealth, however, is the income you haven't spent, the assets quietly accumulating below the surface, providing security and future options. To truly understand money, you don't necessarily need to study complex financial models. What you really need to do is study yourself, your behaviors, biases, and goals. For a deeper dive into these profound insights, I highly recommend reading the book, The Psychology of Money by Morgan Housel.